Hey everybody, it's John King with Summit Funding. It is Friday the 19th of May, and here I am with my weekly update, kind of catch you up on what's going on with the market, with interest rates, with mortgages, all of the above. So what are the topics we're going to cover today? So first thing we're going to cover is entrenched inflation. What the heck does that mean, and why do I care? The second thing we're going to cover is jobless claims and what that means to the market right now and how that's really been impacting rates in the last 24 hours. The third thing we're going to talk about is the Fed changing its tune? Like, what's happening? What story are they telling us? What's the real story and why? And then finally, I'm going to talk about the HAF Closing Cost Assistance Program and the fact that it's got some funding coming back. So super, super excited about that. So let's go ahead and dive in. All right. First of all, I want to talk about the entrenched inflation. What the heck is entrenched inflation? Entrenched inflation means that people expect inflation to continue and they start making decisions based on, yeah, this is normal. Well, here's what's been happening with inflation. We saw inflation skyrocket up and hit the mid 9% range, and then it came back down to around 5%, and it stayed there. It hasn't come down anymore. And the worry now is 5% normal inflation? Is that what we're going to see going forward? And I'll give you a simple story to think about this. If you're getting a quote from a contractor to fix a fence at your house, and the contractor says, hey, that's going to be 10 grand. And you say, gosh, I was kind of expecting it to be more like 7 grand, but well, I guess with inflation, I guess that's just what things cost. And so you'd say, oh, okay, Mr. Contractor, I accept. That's in part because you're accepting higher prices simply because you expect higher prices. Now, I'll get to why that's a bad thing in a second. But the alternative is if you didn't expect higher prices, you'd say, whoa, hold on a second. I expected that to be closer to 7 grand. Do me a favor, go sharpen your pencil and figure out what you can do to make that cheaper for me. You're going to push back a little bit on that increase in prices. As a matter of fact, it can get even worse because you might start having companies say, hey, I've got great news. This year, our price is only going up by 5% compared to the 10% it went up last year. Isn't that amazing? And everybody's happy. And they're saying, wow, that's great. That means that I don't have to pay 10% more every year. I only have to pay 5% more every year and become accepting of that. That's the simple definition of entrenched inflation. Why is it a problem? Well, it's a problem because, first of all, inflation will continue to build upon itself because companies will say, look, I can raise prices and sales don't fall, which is really what stops companies from just charging as much as they possibly want. Is there's a supply and demand curve. In economics, it says, look, if I raise my price by 10%, at a certain point, I'm going to start losing more clients. So if you double your price and you lose half of your clients, you make the same amount of money and you do half the work. So that's not a bad deal. But if you double your price and you lose 80% of your clients, well, now you have a problem because now you're only making 40% of what you had made before because you lost 80% of your clients. You only have 20% left. Yeah, you may double on those people, but you only have 40% of the revenue that you had before. There's a sweet spot. Okay. Too cheap is not good. Too expensive is not good. But it's that sweet spot that stops companies from continuing to increase their prices. Except when the consumer accepts that, then the company is going to continue to increase their prices. But what that means is the consumer, in accepting inflation, says, hey, Mr. Employer, I need you to pay me more money because I can't afford to live anymore. I'm going to go look for another job that will pay me more. Now, why is that other job willing to pay more? Because they're raising prices, so who cares? And so it becomes a self-fulfilling prophecy. It becomes, and this is what happened in the 70s, is we had entrenched inflation. It is the biggest thing the Fed is afraid of. And so the Fed is concerned that, hey, if we continue to see inflation entrenched the way that it is, then we've lost control. We need to get inflation down to the 2% level is what they're looking at. And inflation fell from the peak of 9 back down to around 5, and it's staying there. And inflation is the Achilles heel of mortgages because inflation erodes or decreases how much the money the mortgage is bringing in down the road really is worth. Those 3% mortgages, 2.5% mortgages that we did 2 years ago, they're making negative returns. Okay. In other words, the banks, the Wall Street invested in these mortgages and said, yeah, I'll buy $1 million mortgage and I'm going to make 2.5% per year. Well, if they just would have kept that money in cash, it would have been zero risk. And right now, their returns are even higher than that. The Fed funds rate is significantly higher than that. The average CD is paying more than that 2.5%. And so the bank says, man, I'm making 2.5% income on this, but the cost of paying my employees, the cost of paying for goods and services is going up by 5% per year right now. We're losing money. And that's what causes the problem of where mortgage rates have to go up, because they have to say, hey, if the cost of everything is going up by 5%, then we have to charge at least 7% for mortgages in order to stay ahead of that curve. And it's continuing to put upward pressure on mortgage rates. So as much as we've expected to see inflation coming down, it's not coming down as quickly as we would like. So that leads to the fear of entrenched inflation. Now, here's the other side of that coin. Remember, the Federal Reserve has two jobs. They have to keep inflation in control, and they have to keep maximum employment. In other words, keeping the most number of people employed. Those are the two mandates that they have. And sometimes they have to sacrifice one for the other. And right now, their biggest concern is inflation. They're willing to sacrifice the number of people that are employed to fix inflation. And they're actually literally trying to increase the unemployment rate. And that's part of what's happening right now that's even more worrisome. So there's a statistic that comes out every week that is called the jobless claims. And every single week, we are seeing how many people for the first time last week applied for unemployment benefits. Now, not the first time ever, but like they had a job and now they've lost a job and they're applying for unemployment benefits. Now, the next week, they're still unemployed. That's called a continuing claim. So you have initial claims, and then you have continuing claims because, hey, you might be unemployed for 8 weeks. So week number 1, you count as an initial claim. The next 7 weeks, you count as a continuing claim. So what we're looking at, what this statistic looks at, is how many people became unemployed last week. And the Federal Reserve wants that number to go up. They want to see more people become unemployed. Now, that sounds backwards, but the truth is if more people are becoming unemployed, then they're not going to be able to spend as much money buying goods and services, and therefore it should help lower inflation. And that's the number one tool, both tool and also feedback or method for the Fed to figure out, hey, do we think we're on the right track to decrease inflation? Well, guess what? If companies are still hiring a whole bunch of people, then inflation is not going away anytime soon. Well, last week, the jobless claims numbers went down. So they've been moving up for the last month, and that's been good because it's been really pointing towards, hey, we're seeing more people becoming unemployed. Again, this is backwards thinking, but for what the Fed wants to decrease inflation, they want to see more people be unemployed. But last week, fewer people started the unemployment, became unemployed and filed for the first time unemployment benefits. That number was published yesterday. So it's through Saturday. It gets published the following Thursday. The markets do not like it. The 10-year treasury rate shot up. Mortgage rates have shot up in the last 24 hours. It is huge volatility right now. And what we're dealing with is uncertainty about what the Fed's going to do. And that's my next concern. The Fed seems pretty clear that they're starting to change their tune back to raising interest rates. And their concern is this entrenched inflation. Their concern is that we're not seeing unemployment numbers go up. And so the Fed is saying, look, I'm worried about this. I think we're going to be in a position where inflation can be a longer term problem. And I actually don't blame them because this is what happened in the 1970s. Is the Federal Reserve didn't go far enough, long enough. And it wasn't until Paul Volcker, the head of the Federal Reserve in 1980, said, you know what? I'm going to raise rates as high as it possibly takes to squash inflation completely. It's like taking antibiotics. You take half of your antibiotic treatment, and then you say, oh, I feel better. I'm going to stop taking my antibiotics. The problem is you may feel better, but the issue, the bacteria that's inside of you is not completely gone. Well, now you stopped your antibiotics, that bacteria is not completely gone, and it comes back and it's resistant now to that antibiotic. Same concept. If the Fed doesn't give us enough medicine, and sometimes it's more medicine than we think we need, but if the Fed doesn't give us enough medicine, which is what they did in the 70s, inflation becomes entrenched. We end up with continued problems because the Fed goes just to the brink and then they pull back. So the Fed, to me, sounds like they really are either A, trying to be saber rattlers and saying, hey, guys, you better not keep being loud back there. I'm turning this car around and we're not going to Disneyland. Full well knowing we're going to Disneyland. So they could just be saying it for show, but I honestly think they might be serious. I think the Fed right now, looking at the fact that inflation has not dropped much more, looking at the fact that unemployment numbers are not going up, I honestly think that the Fed is not as likely to pause. They're really going to push harder to give us all of the remaining medicine that we need, and none of us want to take it. But the fact of the matter is, if we don't take the rest of the medication, the virus, the bacterial infection is going to come back even worse. Inflation and the problems with the economy are going to come back even worse. All right. Now, I have had some people ask me recently, John, the housing market, it has to crash if we end up in a position where the Fed gets what they want, and the Fed is going to raise unemployment rates, and they're going to cause millions of people to become unemployed. I had one guy in a YouTube conversation say, look, even if 1.1% of the population becomes unemployed, that's 1.6 million people that lose their job. And if half of them are homeowners, those people can't afford their payment anymore. And therefore, we're going to have 800,000 homes hit the market. Here's the deal. We still have millions of people working and millions of people renting that want to become homeowners. The pent-up demand is so high because of the delayed buying that happened over the last 10 years. So again, quick history lesson, 2007 market crashes and everybody says, you know what? I can't buy a home because I have a foreclosure, or I don't want to buy a home because mom and dad lost their home to foreclosure. Home ownership's bad. You also had millennials who were saying, you know what? I don't want to be an adult. So I'm going to move back in with my mom and dad and I'm going to live in their basement and I'm not going to buy a house. And so millennials postponed what's called household formation. Household formations are the number of people, or a household is formed when somebody moves into a new home, rented or purchased, without vacating another one. So when mom and dad and their kids all live together and then one of the kids moves out, mom and dad stay here, the kids move out, that's a household that was formed. Well, household formations was delayed with the current millennial generation for multiple reasons, not the least of which was watching their parents lose their homes to foreclosure and watching and worried about, hey, I don't want to become an adult. And now builders weren't building during that time. So we didn't have people wanting to buy houses. We didn't have builders building houses. Everybody was happy. 2017, builders are building again. Buyers are buying again. 2020, builders can't build that much faster, but buyer demand skyrocketed. Everybody who postponed buying said, rates are at 2.5. I want to buy a home. Well, now you've got a problem because you don't have enough homes for them to buy. It's just like if you were at a college football game, it's the college championships, and your team just won the championship. And you see all of the fans come out of the stands and onto the field, and everybody's there all at the same time. Well, that's what the housing market did in 2020. You had all of this pent-up demand, millions of people who wanted to buy homes, and everybody jumped in at the exact same time. And they're all trying to buy at the same time. And you had bidding wars, and you had to waive your contingencies. And guess what? Then it slowed down because the Federal Reserve said, hey, we can't have this. We can't have this kind of inflation. We can't have this stuff happening. Yet builders couldn't build homes any faster. They had supply chain issues. They couldn't get the garage doors or the microwave ovens. And they couldn't find workers as easily as well. So now you can't build enough homes to keep up with the demand. And so the people who are right now renting, they're waiting on the sidelines. So you think about that college football visual that I gave you where everybody stormed the field. Well, guess what? The Federal Reserve raised interest rates and they now have left the field, but they didn't go back into the stands. They're just waiting on the sidelines. And as soon as the star quarterback comes out of the locker room, everybody's rushing the field again. That's when interest rates start coming back down. Interest rates come down when unemployment goes up. So when you see unemployment increase, The Federal Reserve wants to keep everybody fully employed. So the Federal Reserve uses interest rates to drive the two things they're trying to control: inflation and employment. So as unemployment goes up, that drives inflation down, but also then the Fed starts lowering interest rates to get companies to spend money, to get companies to invest in the future, and to get them to hire people. And so that's the balance. That's the kind of the yin and the yang of what the Fed is doing. And so to the people who are saying, John, we're going to have, 1 million homes on the market that are going to be listed for sale, and that's going to cause the market to crash. That is nowhere near the number of people that are sitting on the sidelines waiting to buy a home, praying and wishing that they can buy a home. Those people, as soon as we see any amount of inventory and we see interest rates fall, are flocking back to the market. And that's what's going to cause the housing market to not only not drop, but I believe it's going to cause the house prices to continue to go up because we still don't have enough homes built. And that's our biggest challenge. All right, I want to move on to the final topic for today, and that is the Housing Affordability Fund Down Payment Assistance Program through the California Association of Realtors. So this program will provide up to $10,000 of assistance to anyone who is a first-time homebuyer that meets certain income limit requirements. So definitely there's an income threshold. It is specifically, you have to be working with a licensed real estate agent. So you can't do a for sale by owner or anything like that. There's got to be a real estate agent involved. And the final caveat is you have to meet one of three categories. You either have to be a person of color, you have to be a person who has a physical or cognitive disability, or you have to be a person that's a member of the LGBTQ plus community. So this program had about $1 million in February of 2022. And that money ran out a couple of months ago. So it took about a year for them to run through that money. And now they have about $250,000. Actually have $500,000, but they split the state down the middle, north-south. So basically the northern half, which by the way, there's much more geography in the northern half, has $250,000. The southern half has $250,000. They think this money will last 3 months or so. Now the final key is you cannot have more than $20,000 remaining in assets after purchasing the home. So and it's a forgivable grant as long as you occupy within 60 days and you maintain it as your primary home for 3 years. It's forgiven. You never pay back the $10,000. So it's a really, really good program. Lots of little criteria about it. So there'll be a link down below for you to get more information on it. But I think it's a great opportunity for those who meet the criteria. And I'd love to help you make this work. So if you have any questions about this or anything else, let me know. I also did a video today on USDA financing. Great loan program. Check out that video. A lot of good details on how it works and how we can help people. And I'm looking forward to taking great care of you and anyone you know who's looking to purchase or refinance a home, because there's actually a lot of consumer debt out there right now. And the consumer debt problem is ballooning. I've got more clients that are talking to me right now about paying off credit card debts because, well, we kind of had a whole bunch of free money in 2020 and 2021 from all the pandemic stimulus, and people have gotten used to spending that money. And now the free money is gone, but they're still spending the money. And credit card debt has ballooned in the last year. And so if you know somebody or if you're in that position, you've got a lot of equity in your home. Yeah, you have a great interest rate on your mortgage. But when we start adding up how much interest you're paying on your credit cards and all of those other debts that have skyrocketed, you're actually sometimes better off combining it all together into one. Thanks so much, guys, for listening to me. Hope you have a wonderful weekend, and we'll talk to y'all soon. Bye-bye.